Good morning, everyone. At Hodes Weill, we've been reflecting on the implications of Brexit for the real estate institutional capital markets and are happy to share some thoughts on this important topic. We thought it'd be interesting to start by reading some of the news headlines I've read the past few days following Brexit. For example, London to lose tens of thousands of jobs after Brexit, quite negative, compared to will Brexit turn London into a real estate hotspot? And then we have housing market feels immediate chill from Brexit, alongside Britain may reap the benefits of Brexit in the short and medium term. And then everyone has their own view on how this is going to impact them. So we have India's software industry faces uncertainty after Brexit, to Brexit means trouble for Seattle area tech, aerospace, but don't worry, not commercial real estate. And then the New York Times spreading a little bit of fear with Brexit doesn't mean game over, it's just the first domino to fall. And of course, Donald Trump, Brexit shows I'm onto something. So I think you've heard a variety of views about the potential winners and losers of Brexit, and that uncertainty is likely to persist for some time. But as we all adjust our business plans accordingly, we do know that lawyers are going to have plenty to do to figure this out. I would like to spend just a few minutes discussing what we're seeing with respect to institutional allocations to real estate and how Brexit may impact those trends. So by way of background, Hodes Weill partnered with Cornell University's Real Estate Graduate Program to survey institutions globally on their real estate capital allocations. And when I say institutions, I mean sovereign wealth funds, pension funds, insurance companies, and we've published our survey for the past 3 years, most recently last December, which included 240 investors from over 30 countries, representing over 11 trillion of AUM and about $1 trillion of real estate assets. So we think quite representative of the market. We launched our 4th survey that will be out later this year, but we still think a lot of the data points from December are very relevant, and it'll be interesting to see how they evolve over time. The first topic I'd like to cover is target allocations to real estate. We concluded that allocations to real estate continue to increase, albeit at a moderating pace. The target allocation to real estate now stands at 9.6%, which is up 25 basis points from 2014 and 65 basis points from 2013. Institutions have indicated intention to further increase target allocations by an additional 30 points, bringing the target allocation to just under 10% of their total AUM. So what does Brexit mean to all of this? I would comment that most institutions decide on their target allocations on a periodic and often annual basis. So this figure is not a number that is regularly adjusted on a day-to-day or even monthly basis. In fact, there are many reasons why institutions may continue to increase their allocations to real estate, not least of which is favorable monetary policy or the poor performance of the traditional asset classes like equities. At worst, we believe target allocations are likely to remain flat at around 9.5% to 10%. So just moving on, the amount of underinvestment relative to the target allocation in real estate may be a very different story, and it's important to make a distinction here. So in December, we found that investors were significantly underinvested relative to their target allocation. On average, institutional portfolios were 8.5% invested in real estate, which is about 1.1% below their target allocation. So, which was 9.6%, which I mentioned earlier. So several factors contributed to that underinvestment, including portfolio realizations resulting in a substantial return of capital, and often that's well ahead of expectations given how low cap rates have remained. And that reduces the numerator in that 8.5% calculation, as well as increasing target allocations to real estate, which increases the denominator in that calculation. So now, given the performance of equities, there is concern about the other denominator effect, which would of course impact real estate capital flows negatively. So we should all remember that in the first 10 days of 2016, the S&P 500 recorded its worst start to a year in history before falling below 1830 in February, which is 10% below yesterday's close of 2036. And throughout the turmoil at that time, we did hear from several institutions that their CIO put them into a holding pattern. However, most institutions have been planning for volatility and proceeded to continue investing, albeit cautiously. So if equities were to decline by a much larger amount from this point, which is again 10% higher than we were earlier this year, we would see a more pronounced denominator effect. But as of now, it's business as normal, kind of until it's not. So just moving on, we also asked institutions to rate their level of conviction on a level from 1 being bearish to 10 being bullish. So between 2013 and 2014, investor sentiment declined pretty meaningfully from 6.4 to 5.7, and then last year continued its downward trend to 5.6. At that time, institutions were concerned about asset pricing, geopolitical risks, and at that time, rising interest rates. So what does Brexit mean? I think going forward, a lack of investor conviction may persist for years to come, given the complicated timeline for executing on the divorce from Europe, as well as other potential political turmoil globally. It is possible that some institutions will want to pause from actively allocating new capital, but it may be very difficult for these institutions to remain on the sidelines for years to come until there is a clear resolution. For example, liability-driven investors, most notably pension plans, are under the most pressure to put out capital, giving fallen equity, or under potentially the most pressure, giving fallen equity prices and increasing liabilities due to falling interest rates. So these liability-driven investors, they simply cannot stop investing the contributions they receive, so their time out from the market may be rather short. Some other brave institutions may even seek to capitalize on the market volatility and potential illiquidity out there, and this is an approach that has served these investors quite well in prior market dislocations. So, for example, the plunge in the value of several European banks could lead to these banks to begin to liquidate assets to maintain proper capital adequacy ratios. So a portfolio of non-performing loans will likely be the first to be liquidated, but the sale of higher quality assets may be required if bank stocks continue to sell off and they have liquidity issues. So while shareholders of certain banks may be less than thrilled with the volatility, distressed debt managers and private lenders in Europe certainly stand to benefit. With respect to the type of risk-return strategies that LPs are seeking, we've seen a larger increase in the appetite for higher-yielding strategies such as value-add and opportunistic. Although appetite for core certainly remains strong, it'll be interesting to see if the 2016 results trend the same way they have been trending, given the seeming flight to safety that everyone is anticipating following Brexit. While the time it takes to make a decision and secure the capital may be longer, this increased appetite for higher yielding strategies should continue to support the real estate private funds market going forward. So based on our findings, outbound capital flows from Asia Pacific are expected to remain strong over the coming years as institutions in Asia are substantially underinvested in real estate and have been focused on US and European markets. We had a manager there this week who says China is still a place where seeking US investments. Brexit is very likely to impact this trend, though as evidenced by the headlines I read at the outside, the impact could take several different shapes. So some investors are going to avoid additional exposure to the UK and other EU countries, and others may run towards the perceived buying opportunity. Many people out there believe US dollar assets are likely to benefit and attract capital as investors seek safe havens, and still others believe now is a great entry point for any assets denominated in sterling. Even though there's many different forecasts about is the sterling stabilized at 130, 135, or it can go even lower to 115, 120. So there's, as we all know, a lot of different views out there. No one really knows for sure. Further, income-oriented investments in Asia may get a larger share of the pie, as many investors, they seek diversification from the US and Europe, but they want to avoid the uncertainty around the European investment. So overall, we do expect less capital flows to the UK and the EU in the near term. And before I conclude, at Hodes Weill, we spend a lot of time talking about manager selection with managers. Anytime there's volatility in the markets, it's a great opportunity to demonstrate an investor's alpha, how they're sourcing deals, and certainly how they're approaching risk management, which everyone talks about if you get a chance to prove. So, for example, were they actively realizing profits and distributing them ahead of a Brexit? For a fund with multiple currencies, including sterling, was the exposure hedged? You'd be surprised how many don't approach this from a very systematic approach. So the past several years has allowed managers to benefit from very favorable market conditions, and it's times like these that allow these managers to differentiate themselves from the pack and ultimately benefit their businesses going forward. In summary, the initial shock of the UK's decision will soon pass, but there are many important questions for real estate investors that are probably going to remain unanswered, unfortunately, for some time to come. Given the defensive qualities of real estate and the potential upside in stabilizing markets, real estate is likely to continue attracting significant capital flows. We are hopeful that institutions catch their breath very quickly and recognize the many opportunities to be found in these interesting times. I look forward to hearing our other panelists' views during the course of this morning. Thank you.
Great, thank you.
A quick question actually, in terms of capital flows, do you think there will be more capital coming from Europe towards the US? Have you got any kind of thoughts on that?
Sure. I think it's ultimately too early to tell. I'd say generally, anytime there's uncertainty, it affects decision making, and whether the capital flows, ultimately, I think the capital will flow, but it's just timing. So all those fundraising stats, you see time in the market of 12 to 18 months. Unfortunately, I think that's going to persist, if not extend. So it's just anytime you have to make a decision, it's very hard to do so. So the capital is probably going to continue flowing. I'm sure the sterling-based investors are going to seek to diversify their currencies, even though it should have been doing that prior to Brexit. It's hard to know exactly, but I think timing most certainly will be affected.